Welcome back. Picking up on a theme here. Yesterday on this show, notable short seller Bill Fleckenstein revealed he's not getting back into the short game yet. He's not getting in until the Fed gets out of the game. Here's exactly what he said.
The Fed is the problem. It's not the solution. But if you're going to make money as a short seller, as a dedicated short seller like I did it in the past and I intend to do it again when the time is right, you really need a certain backdrop to allow the fundamentals to matter. And quite frankly, even though the Fed has been reducing the amount of money it's still printing enough money that apparently the stock market continues to go up.
Well, reaction now with our own Steve Liesman and Lee Munson from Portfolio Asset Management. Guys, good to see you. Steve, what do you think about what Fleckenstein said? I mean, it's hard to make the argument that the Fed hasn't had a dramatic impact, at the very least, in where asset prices have gone and the difficulty in trading on the other side of what the Fed is doing.
All due respect to Bill, I can't help but think he's contradicting himself in there. I mean, he says the Fed is the problem and you need a certain fundamental backdrop. So fundamental backdrop means to me a fundamental backdrop in the economy, which if he means the fundamental backdrop in the economy and the Fed is the problem, then what's he saying? Is he saying that the Fed is helping the fundamental backdrop in the economy or hurting that backdrop? And if all he's saying is that he'll get in when the Fed gets out, I mean, I wish investment were that simple, but if that's all you're going to do, it seems to me like you could be making a mistake in that if the Fed gets out, it's getting out at a time when the fundamentals of the economy are improving.
Remember, it actually was that simple the last couple times the Fed tried to end quantitative easing. So it's been the case in the past that you didn't want to fight the Fed. That is true, Kelly, and an excellent observation, except I might point your attention to the recent history of the stock market, which has been much less concerned with the commentary coming from the Federal Reserve. I mean, I think if anybody knows anything, we know the QE is going to end in October, and sometime next year with a debate about whether or not it's spring or summer, and I think given what's been happening, it's more springy than it is summery, and the market doesn't seem to care. In fact, what's been happening is bond yields have been falling, and stock prices have been buoyant. And especially with the point about stock prices, Steve, seems to indicate that this time the backdrop is more resilient. Lee Munson, have we reached that point now where the backdrop, where the economy, where the fundamentals are more resilient, so the market's not so freaked that the Fed might exit here, or is exiting here?
Well, no, I think that, it's one of those things where, I would rephrase this thing about the Fed. The business cycles don't end on their own. The Fed kills them. But that being said, it's not about QE. We all know that QE is going to end. It's really about what kind of hikes we're going to have next year. But the bottom line is that it's summertime right now, and you got to invest you got to go out and play. You can't be worried about winter coming and say, I'm not going to go out and invest in stocks because eventually the Fed's going to raise rates and that's going to cause a problem. We've got so much slack, and we're letting a few hawks on the Federal Reserve try to convince us that they're going to push Yellen's hand because they want their next speaking engagement at a big Rotary meeting. So I think you got to still be invested, and you don't have to worry about what's going to happen a year or two from now.
Part of the issue, though, Stephen, I think it speaks to Fleckenstein's point, is that with the Fed doing what it's doing, it's awfully hard to figure out why certain things are happening in the market. I want to read you a couple of things that I got sent to me today from people we all know and respect who appear on this network. One big trader says, confusing is an understatement in describing how to trade this market or why it's reacting the way it is. Another one, QE manipulation of global interest rates has been the most significant effect to capital markets since the listing of the first shares on a public exchange. What's your reaction, Steve?
When people say that, and I hear that a lot, the Federal Reserve, no matter where it is manipulating interest rates. And the idea that it's manipulating interest rates more now and it's somehow crossed some, I don't know, heretical threshold in the capitalist handbook, I really am doubtful of. Because where would you set interest rates appropriately for the current environment when basically people are willing to lend the Italian government money at less than they'll lend it to the United States? That speaks to me of a highly risk-off mentality that's out there. And so the Federal Reserve should be leaning against that. That's appropriate policy. That's what we hired the Federal Reserve to do. There's always manipulation going on by the Federal Reserve, and the idea that somehow there's a limit to it, given the backdrop of the economy, it doesn't strike me as they've hit it.
and fair point, Steve, but Lee, the thing that is different this time is that they've had to use different tools to try and get that interest rate past the zero bound. And the question is, will it be as smooth on the way out as it was on the way down?
That's a legitimate question. I think that's not written. I think Bill has a point, and it may be just that simple. That when the Fed gets out, you want to get out of stocks. It may be that simple. I would only point out that ostensibly that's at a time when revenues are growing at companies, which has not been the case for many years, and the economy is growing more strongly.
Yeah. Lee, you want a quick last word there?
Well, but you also have to have some. Yeah, here's the thing. You have to have some sense of history and look back. When the Fed starts raising rates, usually it's anywhere between 6 to 24 months afterwards that we head into a recession. So once the Fed starts raising rates, that's not the time to panic. That just means it's fall, and you should be thinking about winter, but you shouldn't be getting your winter coats on and heading indoors. So I think you got to relax. You got to remember, I don't think that we're going to see a huge hike. I think it's going to be fairly smooth, and I don't think that the end of this cycle is going to be nominally really high. So the idea that we're going to have 5% federal funds rates in 2 years, I think people are out of their mind. The Fed is part of the fundamentals.
All right.
Thank you, guys.
Guys, thanks. Cal, I think part of the issue here is that, and maybe this is also what Fleckenstein's talking about, is that there have been many events that have been in front of us over the last couple of weeks that would give a short seller or anybody who wants to be bearish reason to be, geopolitical and otherwise, and yet the market closed above 2,000 yesterday for the first time ever. So it's a throw up your hands, and as I said in that one quote, confusing is an understatement, because you would think that, yes, this is the opportunity that we've been waiting for, and don't fight the Fed.
But look, I have to say, there's been a rather populist, it's been the big guys, the big money, the smartest guys in the room who have all been wrong. Who's been a macro fund that's had the right call on this market directionally?
It's been a tough market to read, and it's been because, some would say, of what the Fed is doing.
Scapegoat. Maybe. I don't know.
All right, 35 minutes to go before the bell rings. The S&P 500 just below 2,000, 1997. Dow is at 17,107. A gain of 1 point.
American Airlines pulling its fares from orbits, causing Orbit stock to lose altitude this week. Will travelers start going straight to the airline's websites now to book flights? Our pros will weigh in.
March 2000, the NASDAQ first hits 5,000, then it all went south very fast. But is retaking NASDAQ 5,000 finally within reach more than 14 years later? Our Seema Modi has a special report coming up.